Trump's tariffs are cancelled, the silver price is climbing quickly, and the miners are printing money. Welcome to your weekly recap of the precious metals markets and mining. Hello everyone, and welcome to Sound Money Stacking, where I help everyday people stack physical precious metals and try and understand what affects the precious metals markets and the mining stocks. In this weekly recap, I will go through the main news affecting the precious metals markets, the weekly chart data, and some broader context, and then I will end with a report on a big week for the miners, many of which have reported bumper quarterly earnings. If you want to help me continue to make these time-consuming updates, please consider giving this video a like and making a comment. Your comments give me feedback on what you find helpful or what I missed, and they also tell this platform to recommend these videos to people like you. I've also got a link to buy me a coffee account if you want to keep me awake when making these updates. Okay, get comfy, grab a drink, and let's get started. The big news of the week came on Friday, which I noted last week could happen. The United States Supreme Court ruled that the most sweeping global tariffs imposed by President Trump last April are unlawful. Specifically, these are the duties that were justified under a law empowering the president to respond to national emergencies. The tariffs at issue in the Supreme Court case represent about half of the Trump tariff bill. The duties were justified using a 1977 law, the International Emergency Economic Powers Act, or IEEPA, which gives the president the power to regulate trade in response to an emergency. Trump said that the duties were a response to drug trafficking and trade imbalances, and that they would encourage investment and manufacturing in the United States, paving way for an economic revival. But they amounted to a tax, of course, which requires an act of Congress. The tariffs are raising about $30 billion in import duties a month, which is 4 times more than normal, but this only amounts to about 5% of government revenue. Most of the cost of tariffs is being paid by US businesses and their customers. The refunds will be messy and take time, and will businesses return these fees to their customers? Trump has said that he will use other laws like the Trade Act of 1974 and the Trade Expansion Act of 1962 to apply other tariffs instead, but these are more limited in size and duration. They also require a longer process to adopt. Trump's response has been to double down on his tariff rhetoric, suggesting that he intends to continue with his tariff policy, and indeed in a press conference on Friday evening, he added a new 10% global tariff under the Section 122 as his response. However, the increasing cost of living is hitting Trump's domestic approval ratings, and the tariffs haven't helped this. There may not be much appetite for new tariffs among his supporters. There are also no signs that Trump's tariffs have sparked a revival of domestic manufacturing or an economic revival to date, which brings me on to the next news item. US GDP only grew by 1.4% versus an expected 3%. The temporary US government shutdown is being blamed for this, but the wider economic picture in the US does not look encouraging. Job creation has been very low. Consumer spending is down and inflation is higher than expected and growing. This is looking more and more like the start of a period of high inflation and stagnant growth, termed stagflation. Such periods are extremely bullish for gold and silver. Gold prices fell on Tuesday on reports of progress in the talks between the representatives of the United States and Iran on nuclear reactor and uranium enrichment. These hopes were quickly dashed as Iranian generals and leaders resumed their aggressive rhetoric. The US has accumulated considerable forces near the Arabian Gulf. The USS Abraham Lincoln and its support fleet are off the coast of Oman. The USS Gerald Ford transited through the Gibraltar Strait on Friday. More than 150 US military cargo flights and several fighter jets have been tracked making their way to the region. It'll probably take more time for the US to assemble everything, but a strike does appear to be close. This is unlikely to be a quick hit like the Venezuela operation. It may go on for some weeks. However, it probably will be limited to airstrikes intended to weaken Iranian defences, along with a missile launching capability and nuclear capacities. I'm not sure what the US thinks it's going to achieve here. Will these attacks promote a regime change in Iran? Probably not. What they will do is increase regional tensions and global uncertainty. Bloomberg reported that US agencies have developed a critical minerals price floor system. A critical minerals price floor system refers to a policy mechanism designed to establish minimum reference prices for key minerals at various stages of production and trade. These floors are typically enforced through adjustable tariffs or trade agreements among allied countries, preventing prices from falling below predetermined levels due to market flooding or predatory pricing from dominant suppliers such as China. For metals and mining prices overall, the system acts as a safety net by guaranteeing minimum prices, which reduces downside risk and market distortions caused by oversupply. This stability can transform project economics, making it easier for mining companies, especially junior explorers and developers, to secure financing, plan long-term operations, and attract investment. Under-Secretary of State for Economic Affairs Jacob Hellberg said, "We have multiple agencies to take a close look at this. They've developed a very, very sophisticated price floor system that we are having conversations with our allies and partners about," end quote. And he said this at the Defence Tech Leadership Summit. He also said, "We're very excited about it because pricing is the key to unlocking private investment," end quote. Silver was added to the US Geological Survey's critical minerals list in late 2025 due to its essential roles in electronics, solar panels, defense systems, and clean energy technologies. Our modern world does not exist without silver. You would not be watching this video without silver. And silver production has been in structural deficit for the past 5 years. A price floor system could significantly impact silver prices by treating it as a national security asset, potentially guaranteeing above market rates through government procurement, stockpiling, or tariffs to secure domestic or allied supply. This might force global buyers to pay more, reducing volatility and creating sustained demand beyond traditional cycles. With silver already hitting record highs, such policies could amplify upward pressure, with producers prioritising sales to protected markets. For mining companies focused on silver, price floors de-risk their operations, and critical mineral status should accelerate permitting in the US at least. These political developments enhance the leverage that miners have to both policy and price upside. What will this growing price for silver mean for industrial users? Well, most sensitive perhaps are the Chinese solar panel manufacturers, who rely heavily on silver paste for the conductive grid lines on photovoltaic cells. Chinese manufacturers have recently faced local physical premiums of over 10% more than the London spot and New York futures prices. These premiums for acquiring physical refined silver, especially processed silver paste produced in Japan, are likely to grow. Silver paste now accounts for as much as 30% of the total solar cell costs, which were only 5% in 2023. And have now overtaken polysilicon as the largest input expense. This has squeezed already thin margins amid overcapacity, prompting thrifting to reduce silver usage per cell, and has accelerated shifts to cheaper alternatives like copper, which could save the industry about $15 billion annually if this scaled up. However, these adaptations will take time to come through, and short-term cost pressures persist, potentially eroding solar's competitiveness as the cheapest energy source in many regions. Last month, China announced the termination of the VAT rebate on solar PV exports, which comes into effect from April 1st, 2026. This adds an additional 9% cost onto solar PV exports. This policy aimed to curb overcapacity, price wars and trade tensions, but it's led to panic buying and accelerated industry consolidation. Cell producers have hiked quotes by 10 to 30% since mid-December 2025, with some suspending orders or renegotiating contracts amid the cost surge and rebate uncertainty. The reason I cover this in this update today is because what is happening in the solar PV industry is playing out elsewhere. This leads to a wider conflict of interest. Politicians are bringing in protectionist policies, leading to the creation of price floors and strategic reserves and locally priced markets for physical silver and other minerals. This is a return to an era of mercantilism versus the globalism of the past few decades. These policies clash with the desire of large industries who want to remain competitive and be able to supply customers in a timely manner. These conflicts of interest will play out in the markets, where different parties seek to control price in different directions, and this will result in price volatility. Looking at the precious metals charts this week, we can see that the gold price has turned around and is up 1.8% on the week, closing over $5,100 per ounce. It appears to be in a sideways consolidation phase at this time. The Chinese markets return from their holidays next Tuesday. There may be some buying demand there, and this might kickstart a new accumulation leg soon. The GDX Gold Producer ETF is up 5.3% this week. You can find a link to my Trading 212 pie of gold mining stocks in the description to this video. There's also an affiliate link for new customers to get up to £100 worth of free shares. I took up such an offer in the past to buy my first shares on Trading 212. Meanwhile, silver has had a very strong week, up 7.7% to close at $84.50 per ounce. It briefly touched the $72 area of support I highlighted last week. Now, I did think it might have gone a little bit lower, but Tuesday's low was precisely $72.00. Somebody seems to be watching my videos. We can expect some resistance in the $92 area before any move towards the all-time highs again. Let's see what pent-up buying there is when the Shanghai markets reopen on Tuesday. The SIL Silver Producer ETF was up 9.5% this week. You can also find a link to my free Trading 212 pie of the best silver mining stocks in the description to this video if you want to join the thousands of other investors who use it for free. So, looking at the gold miner quarterly earnings that have come out this week. So firstly, Newmont, they reported very strong results thanks to a high realised gold price. Their revenue beat expectations by 10% and their earnings per share beat expectations by 23%. They paid off $3.4 billion worth of debt in 2025, but still have some way to go before they clean up their balance sheet. This and the fact that their production is not growing, it's actually falling for next year, is why I don't have a large position in Newmont. By the time that they can realistically afford to purchase more mines, the prices of the mid-tier producers will have increased considerably. AngloGold Ashanti is a major producer with mines throughout Africa, Australia and the Americas. They had a reasonably good quarter. Their revenue was in line with expectations and their earnings per share was just slightly below expectations, but performing as expected. They have been reducing their debt burden in 2025, but have got some way to go. Kinross Gold, they've got many mines in the United States, Mauritania, Brazil and Chile, and they're one of the best performing gold major producers. Their revenue was in line with expectations, but their earnings per share beat expectations by almost 22%. Their cost of production is a bit lower than the industry average. They would be more attractive to invest in if they cleaned up their balance sheet more. They are getting there. Their production is going to remain the same probably until about 2029 before it starts to increase. Lundin Gold is one of my favourite mid-tier gold producers. All of their production comes from just one asset in Ecuador, but what a strong asset it is. It's a very low cost mine and it's got a lot of life ahead of it. Their revenue and earnings per share were in line with market expectations. They did report a few days ago that they've discovered a fifth porphyry system at their asset and are drilling all of their assets at an extreme pace. So Lundin Gold have the ability to grow their production at very low cost without needing to embark upon expensive mergers and acquisitions. They don't need to build mines, they just need to develop their own. That one asset will probably turn into at least 5 different mines, all running from the same operation. Alamos Gold is a Canadian and Mexican producer. It's executing well, but it doesn't have much growth potential, so I'm not an investor in it. Its revenue was pretty much in line with market expectations, and its earnings per share were a 10% beat. There will probably be a shark and acquire other North American assets in time. They still need to clean up their balance sheet first, and this will take some time. Equinox Gold have mines in Mexico, Canada, and the USA. They've had a very strong quarter, beating earnings expectations handsomely. They merged with Calibre in 2025 to acquire low-risk Canadian assets and sold off their 3 Brazilian mines in December 2025 for $1 billion to enable them to clear a large part of their debt. They should have a clean balance sheet after the next quarter and then can look to grow their assets. Industry legend Ross Beatty is in charge, and I see a really strong future for them, and they're a company I like a lot. Eldorado Gold have got 4 operating mines in Turkey, Greece and Canada, and they are developing 2 new mines in Greece. They've had a strong quarter. They beat revenue and earnings expectations, and this could be a very good story going forward. Oceana Gold is one of my favourite mid-tier gold producers. They've got mines in the United States, New Zealand and the Philippines. They've had a very strong quarter. They're predicted to increase production and lower the average cost per ounce in 2026. They're performing very well indeed, but they now need to grow their portfolio by making solid acquisitions, as their exploration sites are some way off from development. Beta Gold are continuing to struggle. Their revenues and earnings were some way below market expectations. They forecast an 8% decreased production in 2026, and the average cost to produce an ounce of gold is going to increase by 63% next year over this year's cost. So that's really awful news. And 50% of their production is from the high-risk jurisdiction of Mali. Looking at the silver miners, Pan American Silver has got many mines in Latin America and Canada. They've had a very strong quarter thanks to the high silver price. They realised a small premium over the spot price, so they're selling it for more than the market value. They did not pay down any debt last quarter, which is very disappointing. Now they are in a position to clear this, but what they're probably doing is letting their recent acquisition of Mag Silver last September to bed in and build up a cash reserve before clearing their debt. They are priced quite cheaply by the market considering their extremely strong future ahead of them. Coeur Mining have got 7 mines in Mexico and the United States. They've had a very solid quarter, very much in line with expectations though. They've been paying down their debt in 2025. Their recent acquisitions have lowered their costs and grown their production. They acquired Silvercrest for silver and New Gold for gold. They'll be much more of a gold company now with New Gold on board, but they will print a lot of cash going forward. They're priced very cheaply for the future ahead of them, and I'm very happy to invest in them. Hecla Mining have got mines in Canada and the United States. They've had a very strong quarter thanks to the greatly increased silver price. Now Hecla has still got quite a lot of debt to clear, but did reduce this burden by 50% in 2025. I do expect a clean balance sheet by the end of 2026. Now, what was striking about Hecla's earnings report was that their realised price of silver was $69.28 per ounce, when the average spot price of silver was only $54.83 per ounce for that quarter. Now, early in 2025, Hecla were getting a premium of between $1 and $3 over spot price, but this has jumped to $14 per ounce premium in Q4. This means that the actual buyers of physical silver were paying considerably more than the publicly quoted spot price in order to secure their silver supply. This is a very significant development and worth keeping an eye on to see whether this happens with other miners. First Majestic have got several silver mines in Mexico. They also had a very strong quarter thanks to the high silver price. They managed to get an additional $4 per ounce premium on their sales of silver. This stock is really coming alive now. They have an extremely strong cash position and they're likely to be active in acquisitions going forward. And I expect that they will go for a company like Avino. Now, in other mining news, the US Department of Justice has vetoed the permitting of the Pebble project of Northern Dynasty minerals in Alaska this week. This project had been approved, but then was vetoed by the Environmental Protection Agency under the Biden administration in July 2025, citing unacceptable risks to salmon fishing grounds. Northern Dynasty appealed this through the federal courts, and the stock recovered with the arrival of the Trump administration. However, Trump's Department of Justice have upheld the veto. Pebble is the largest undeveloped gold mine in the world, although it is currently being designed as a copper mine with gold offsets. Pebble has got £80 billion of copper, 80 million ounces of gold, and 350 million ounces of silver, and £5 billion of molybdenum. Gold and silver are about 33% of the revenue and copper is about 60%. Now, Northern Dynasty Minerals stock has fallen 40% this week on this news, and the company will now have to return to the federal courts. Well, I shall leave it there for this week's precious metals markets and mining recap. It's been another busy week. The Chinese return from their holidays next week, so it should be another busy week next week. Well, if you made it to the end, please help me out, give this video a like and drop me a comment. It helps push this video out to more people like you, and consider subscribing if you found this useful. Thank you for watching and see you in the next video.